Here we've got an exciting guest. We've got Dr. Nelson here with us. But first, why don't we kick things off? Do you guys have any July 4th crazy plans that you guys want to mention?
Oh boy, Jason, we're still in COVID-19 era, and we're just going to be staying at home, sitting in the swimming pool.
Yeah, for me, it's pretty much three boys and a barbecue,
Not bad. Are you at least the one doing the barbecuing?
most likely.
Fair enough, fair enough. Well, cool. I guess let's hop into it. We'll start with Dr. Nelson. Do we want to hop into some of your background before we go into the exciting press release you guys put out today? You maybe want to talk about where you went to school, your first couple jobs, and then we'll go from there.
Yeah, well, after finishing San Diego State, I moved to Chicago and was actually a floor trader on the Chicago Board of Trade, which gives me a unique perspective on how markets actually function from a nuts and bolts perspective. Then I went from there to earn my PhD at George Mason University, where my dissertation was on behavioral economics. That was defended back in 1999, which gives you a sense of how long I've been involved with behavioral economics and behavioral finance. From there, I was a professor in the University of Buffalo Department of Finance and Managerial Economics, after which I went to join Scott and start our first company. And now we're on our second go-around with Financial Gravity and Applied Behavioral Finance, Inc.
Oh, awesome. I mean, hey, so pretty familiar with the space. You're not a crazy curveball like some of the other people we've talked to where they kind of have nothing to do with it and then get into finance or taxes, if I recall, was a previous. Do you want to maybe go into, so what made you get into, I guess, even behavioral economics? Walk me through even the super early stage of what made you say, hey, like this is something I want to look at.
Early on in my economics career, I recognized that I did not think that human behavior was sufficiently well described by the Homo economicus version, where people have perfect information and make perfectly informed decisions with perfect calculations. I thought people did make systematic mistakes and thought that cognitive psychology had an important role in decision making. So from there was a natural, I actually took a cognitive psychology graduate class during my PhD program. And from there, got involved or interested in experimental economics. Prior to writing my dissertation, I went out to the University of Arizona and studied with Professor Vernon Smith, who actually won a Nobel Prize a couple of years later. And so spent 2 weeks with him kind of learning the craft of experimental economics and the basics of behavioral economics. And that's kind of the start. And so, I literally learned from the father of experimental economics 20 years ago.
Yeah. Do you want to even take, maybe a step back for someone who might not have a, business or finance background? Do you want to even say what is kind of behavioral economics?
Oh, absolutely. So the Chicago school model is basically the people are perfectly informed, they make perfectly good decisions, and everything can be neatly modeled mathematically with very useful directional results. If prices at some point, if prices go high enough, people buy less of that good. So that's like basic price theory. But we kind of figured out, economists figured out that while we were pretty good at directional, the effect of price on direction, we weren't really very good at making precise predictions. A really simple example of that is what's called a dictator game. A dictator game involves one person starting with some amount of money, let's say it's 10 bucks, and then the other person starts with nothing. And the person who starts with $10 can keep it all for themselves or give as much as they want to the other person. And Homo economicus obviously just keeps the $10 for themselves and keeps walking, right? But in fact, a significant number of people gave money to the other person just because they'd feel badly if they didn't. And that's kind of like the simplest example of how Homo economicus would do one thing, but real people would do another thing. And that's what really, that very simple game, and actually building some results around combining that game with some other games, is how I really got started in my publishing in experimental economics and behavioral economics.
Yeah, interesting. Well, the math and what looks on paper isn't always what happens in real life. I guess you see that in a lot of different things. You maybe want to touch on, and pretty interesting already, but talking about how you take behavioral economics into, what you do now with applied behavioral finance. Do you want to walk through kind of that mindset and what made you start? I know we're talking about risk in a little bit, of course, but even if you mention that now, that's fine.
Okay, so when Scott and I started our last company, which was a turnkey asset management platform, I really, while I'd studied behavioral economics and experimental economics for years before that, I really didn't have a full understanding of how critical, let's call it, investor misbehavior was to their investing results. Now, after running our prior company for about 10 years, we learned a lot about what we could have improved. And one of the things that we found we could improve is investor retention. Our turnover was, meaning how long we kept the average investor, was too short. The turnover of accounts was too fast. And we had asked ourselves, why is that? What's wrong? And we figured out that it's because people's expectations didn't match the reality that they experienced. And because their expectations didn't match that reality, they became frustrated or disappointed or lost trust in us or their advisor, and then quit. We lost the client. And so we said, well, what can we do to solve that problem? And so we went out and looked at the existing risk tolerance tools, thinking that, hopefully we'll find one that will solve this problem for us and allow us to align expectations and reality. But what we found actually really shocked us. For example, the number one most popular tool in the market that has almost a 30% market share, almost 30% of advisors actually use it. By far and away the leader in the industry, tells people that if they have a 100% equity, like an S&P 500 portfolio, that they should only expect to have a potential downside of 17 or 18%. But we all know that the stock market has fallen by about 50% twice since the year 2000. It's fallen by more than the 17 or 18% 3 additional times. So that would lead to capitulation potentially once about every 4 years. And I just said, that's not acceptable. That's not a way for us to build a money management business or for an advisor to build their advisory practice. So we figured we had to find a better way. Yeah. And that's where the real risk meter came from.
Well, and we'll get to that in a sec. Touching on a couple good parts. Obviously, you're the expert. They want to feel like you're the expert. And when something happens that wasn't thought or talked about or planned, obviously they become a little bit uneasy and want to leave and go somewhere else. I guess that was the issue you guys were having.
Yeah, absolutely. And that's the problem that we felt it was incumbent on us to solve.
So, okay. So, one of the questions I had was, so what are some of the issues? So you touched on one, let me know if there's others. Obviously the first issue you're saying is that, hey, it doesn't really cover how much the markets have fallen. given previous data. Do you want to cover any of the other issues currently in the market?
Well, other issues with Riskalyze is the scale of their risk number, how they're assigned is very confusing. And you can go to our website, realriskmeter.com, in order to actually read the details on this, because all this information is up there. But for example, in Riskalyze, our clients are given a risk score, investors are given a risk score between 1 and 99, but the first 50 numbers only cover 9.5% of risk. And then I think it's the last 4 numbers, like 95 to 99, cover 20% of risk. And so there's a whole lot of risk crammed up. 20 times as much risk are crammed in per digit in the 95 to 99 range as are in the 1 to 50 range. And so that just makes the tool, kind of unintuitive to use.
Right. So, I mean, I guess then let's talk about what the real risk meter is, and keeping in mind that people are watching this that probably have never seen a risk tool. You want to, again, explain it in fairly easy terms, and then also, go into what makes the real risk meter better than what's out there?
Yeah,
Sure.
Rob, and maybe it'd be a good idea to touch on who the audience is too for the real risk meter.
Yeah.
Okay, yeah. So the audience is really financial advisors that need an honest and understandable way of calibrating their clients' investments to the client's preferences. Again, aligning how much risk the investor wants to take with the portfolio that the advisor is recommending to them. And we consider that alignment and the success of the advisor getting that risk right to really be the foundation of trust in a relationship between an investor and an advisor. Now, more specifically about what the real risk meter does and how it works compared to a conventional risk system is whether it's Riskalyze or Phenometrica or the conventional category systems, all of those start with a questionnaire, and you answer, sometimes 5, sometimes 25 questions in order to get, some output, which might be a specific number, or it might just be a category such as moderate conservative. But there's kind of the black box between the questions that are being answered and the recommendations that come out. And one of the problems we thought is that we want to eliminate as many kind of weak links in the trust, and that black box creates kind of a weak link in the trust, because how do clients know, that those answers are being kind of put together correctly in order to judge their risk tolerance? So instead, we kind of just decided to cut out the middleman, cut out the black box, and go right to the client and say, let's have a conversation about risk and return. So the real risk meter is literally a slider where you can start from 0% risk and slide it all the way up to 50% risk. And if you start at 0% risk, we assume that you can earn a return of about 2.5%. That's, reasonable return for CDs over the last 10, 20 years. But then if you slide it all the way up to 50%, then you could expect to earn about a 10% return. And then everywhere else in between is a weighted average of that, zero risk, 2.5% return, and 50% risk, 10% return. So it really allows the advisor to have a conversation saying, hey, can you handle 10% risk? If you're taking 10% risk, you're getting a 3.85% return or something. Or if you're for 25% risk, you can possibly receive a 6.25% return on average. And then we show how their account would likely grow at those return rates over 10, 20, 30, and 40 years, so that they can see the impact of taking more risk on their long-term returns including the compounding effect, which can really be quite profound for someone who isn't used to thinking in terms of compounding.
Yeah. Do you want to talk?
Maybe touch a little bit on
Yeah.
the output from the SaaS-based risk meter?
Sure. So after the advisor and the client have a conversation, they say, this client's willing to take 25% risk 25% of their portfolio. So if they start with $1 million, they're willing to see their account fall to $750,000 without capitulating. Then it will recommend two kinds of portfolios. First is the traditional stocks bonds blend, and we recommend portfolios in 20% increments. So if someone has a real risk of between, say, 18 and 25, then they'd be recommended a stock bond blend of 80% fixed income and 20% stocks. And then it goes up with breakpoints between the 20% portfolio levels of 18, 26, 34, 42. And then if someone wants a 100, is willing to risk half their money, then they'd be recommended an all equity portfolio. So that's the first kind of portfolio recommendation. The second type of portfolio recommendation is known as a hybrid allocation. And what we do here is calculate exactly how much the client should have in equities, but then we cut the risk with fixed annuities. And whereas our capital market assumptions are that bonds have 10% real risk, and we calibrated that based on the broad market fixed income indexes. Well, fixed annuities are contractually guaranteed not to lose money, so we give them a real risk of 0. So it actually allows an investor with a certain amount of willingness to take risk to have more equities and less of what we call the risk mitigator to possibly enhance their returns relative to the traditional stock bond approach.